Welcome to the Voice of MPE. In this MPE talk series, we bring you fresh insights from top industry leaders and payment professionals. I'm Geoff Barraclough. I write a newsletter and blog called Business of Payments. And I'm here today with 𝗪𝗏 Usta from Flagship Consulting, and we're going to be talking about the convergence of software and payments. So, 𝗪𝗏, would you like to introduce yourself first?
Yeah, absolutely. Thanks a lot, Geoff. And thanks a lot for MPE organizing, such a new format. I think it's really very insightful. And thanks a lot for inviting me along. So my name is 𝗪𝗏. I'm a principal here at Flagship Advisory Partners. Flagship is a boutique consultancy firm focused on payments and fintech. And we've been spending a lot of time on embedded payments, embedded finance, and very much looking forward to a talk specifically with you, Geoff, because I've been following you since many years. And so it's a really exciting opportunity to talk about that topic.
So the convergence of payments and software and embedded payments has not been terribly well researched. But the good news is that, Flagship have been doing quite a lot of very interesting work in this area and have some very useful statistics. So, 𝗪𝗏, maybe we can kick off by you talking us through the work that you guys have been doing.
Yeah, absolutely. So I think, based on our research and what we also observe in the US is that, the US market is really the market where software and integrated payments is most mature. And so what we estimate today is around between 40 and 65% of newly signed SME merchants in the US bought payments through their software platform in 2023. And so the remainder of the market, buying payments from payment service provider, from ISOs, from banks, etc. But that's in the US now really accounting for a minority. And the SaaS being such an important distribution channel in the US, that's something that we also observe in the UK and in Europe. However, the channel is less mature today. And what we do see is that, both regions are around 5 years behind what we observe in the US. However, what we also see is that, both regions are catching up and very rapidly. So we think that, software platforms are going to become a leading distribution channel for payments as it comes to SME payments going forwards.
So we check terminology. When we say SaaS, that's software as a service, and that's the cloud-based delivery of vertical software to in this case, small businesses. And when people say ISV, do they mean the same thing?
Yes and no. So we technically bundle that into the same buckets of business management software. I think the distinction between ISVs and SaaS is that ISVs come a bit more from a legacy side versus, software as a service being really built on the cloud and as such more modern, more agile. But technically, both parties, as it comes to business management software, are still very relevant as it comes to distributing payments.
But for the MPE audience, we're talking about ECR or EPOS software that sits on a till system and takes money in a shop. We're talking about web shop software that allows small businesses to sell online. Maybe we're talking about restaurant management software or hotel property management systems, that kind of thing.
Yeah, correct. Essentially, this shift towards, software platforms or business management software becoming more relevant in payments is really across a lot of different verticals. So you're absolutely right, Geoff.
There's a change in merchant buying behavior. So instead of buying payments separately, maybe from their bank, they're buying a bundle of software and payments together, and clearly they're going to buy or most likely to buy the payment service recommended by their software developer.
Yeah, absolutely. And we'd love to get your view as well on that. What we've seen is basically, SMEs really want this bundled proposition. They want a simple proposition that they can quickly access. And, going back perhaps one step, what is really important to note is the opportunity in integrated or embedded payments is really an SME play, right? because where you see like, large enterprise merchants really solving for more complex needs. They have like, specific software providers that they want to work with. They have, specific payments and product providers they want to work with. If you look at like, the micro, like the SME segment, they're way more unsophisticated as it comes to payments. And I think you framed it really well, as we also see like here on the slide. I think, there are a lot of key pain points that are being addressed for, micro and SME merchants as it comes to integrated and embedded payments.
Because they buy one bundle, one contract, one service, one phone number to call, and it's just easy. So
yeah.
What are the implications of that for the payment processors? Because clearly, in Europe, we've had a history of banks being merchant acquirers and PSPs and bank distribution being very important. So, presumably we're going to see banks become a much less important distribution channel here.
Yeah, that's a good question. It's something that we always debate, to be fully transparent. Like, are banks still going to be relevant in the future? The answer is yes and no. I think it really depends on a country by country basis, but I'm also like really curious to hear like your thoughts in terms of, are banks still going to stay relevant? What we see is, countries such as Spain, France, Italy, it's very much bank driven still today, right? As it comes to distributing payments. Now, are these countries also going to follow the same trend as we see in the US or in the UK, for example, integrating payments, having SaaS becoming such a core distribution channel in the future? The answer is yes. I think.
Yes, I think you're right. There's a long way to go. So I saw some other research last week that still had, for Italy, for example, 80% of small businesses buying a payment service from their bank.
Yeah.
60% in Spain, but down to maybe 20% in the UK. And so, clearly there's a big opportunity for software players in those markets. So I'm quite negative about the future of banks in payment distribution, with one exception, which is I think 𝗃_POS might change things for banks considerably. I have an app-based small business bank account for my business. I got an email from the provider to enable 𝗃_POS on my phone. I clicked a link and pressed a button, and now I can take money on my iPhone for my business. It was that easy. And because banks have their mobile banking app in the hands of so many small businesses who visit that app sometimes many times a day because it's at the heart of your business, I think that gives them an edge in a way they probably don't have with physical branch distribution anymore. So I think the banks that are good at apps with businesses, so I'm with Tide, but Revolut have a huge number of small businesses. I know Revolut are taking payments very seriously.
Yeah, I think, although would love to hear your thoughts, but there's probably a real distinction to make between neobanks and our traditional banks, if that makes sense. So for neobanks, I fully agree. I think 𝗃_POS is also one of the levers where they can really establish, with the ISV, so business management software more generally. What about more traditional banks? Do you think they still will have a right to win in the future?
I think it's going to be very difficult for them, because the branch-based distribution model, where you have business advisors who talk to business customers, nobody can afford to do that anymore. And at the same time, the new players are able to offer a much better bundle, much easier onboarding. That's particularly important because they haven't got the same risk aversion. Possibly, and we saw week before last with what's happened to Barclaycard in the UK, which is the UK's second largest acquirer, and Barclays is rumoured to be trying to divest itself, and also rumoured not to be likely to get very much money for a business that's processing maybe £300 billion a year of payments. So clearly under a lot of pressure and under attack. So unless banks can reinvent themselves or possibly maybe go for scale, so embed the partnerships, the developer-friendly partnerships that allow them to just do one thing well, which is process payments at scale, and let the partners deal with all the customer-facing technology. But that's not what a retail bank is about. A retail bank wants customer relationships, wants to talk to customers. They believe in their brand. So I think it's going to be a bit of a struggle for them.
Yeah, I'm really looking forward to see how banks are going to react, and are they going to invest a lot of money? I think one of the reasons why software providers, the likes of Shopify, Toast, etc., but also SME fintechs have been displacing banks, is also really addressing a part of the market where banks are just simply not very good at, if that makes sense. Serving micro, the SMEs. I think you just need to have like a very different approach. I think it's a very different merchant behavior that you're addressing there.
Well, indeed, but it gets into a slightly different conversation, which is that there are many fintechs that believe that they have a better risk model for assessing how much a small business can afford to borrow and the likelihood of it paying the money back. So many of the reasons why the software companies are trying to get into payments is it's the first of a number of products that they want to sell. Lending clearly being another one, insurance and so on. And this is also, it's worth calling out, this is being driven by investors. So the software as a service model, the vertical software as a service model, is one that investors really like. So there are a lot of venture capital companies and private equity companies want to buy or invest in these point of sale or e-commerce or CRM or hotel management companies, and they're pushing them to monetize with payments. So it's like number one thing they'll say on the list, right? How are you going to monetize payments? Which maybe gets onto another topic, which is okay. So if you're a software company, how do you monetize payments? What are the models that you can follow that will allow you to offer a great service to your business customers, but also to get a cut of the payment pie?
Yeah. So I think perhaps prior to just jumping to the operating models, I think you're absolutely right. Indeed, I think private equity investors, VCs have really pushed, the kind of embedding payments, integrating payments into the software proposition to the forefront. What it also has proven, VC backed or PE backed or, even the likes of Shopify, is that payments are very lucrative, right? Or like Toast, for example, that is now generating, 87% of their revenues from payments. All these numbers are really proving the story around how payments actually are lucrative, right? So what we observe as it comes to operating models is really this kind of learning curve. So a software player doesn't directly jump into this, I'm a fintech bucket. Obviously, at first, starts at the software provider. And I think, Geoff, you'd love to say, I hope I get this right here. Payments are from Venus and software from Mars.
It's the other way around, but it's roughly the same thing.
But obviously, a software platform is really starting, just being a software. And then suddenly, they will start having, in a very loose sense, a couple of partnerships with PSPs. And then very quickly, they will start to realize, I can make so much money out of payments. And will start to, launch their own branded payments proposition, which is generally done on an operating model, which we call payfac light, as you can see on the slides, which means that it's really your own branded payments proposition. You are owning, as a software provider, a couple of value chain components as it comes to payments, but at the end of the day, you're really simply white labeling the payments proposition from the PSP. And then, as a software provider, as testing and learning, and that's really important. And, also very keen, Geoff, to hear your thoughts, but we always see this as this learning curve. You first need to launch payments, then you need to kind of test it. You need to learn how to launch this use case, how to market that, how to approach your customers. And then at the very end of the learning curve, you either go to the next embedded finance use case, or you also consider even bringing more value chain components in-house and perhaps operate as a full PayFac.
Well, I mean, I think that the key thing for any software vendor starting is to understand the payment profile of its customers. So how much payment volume are they doing? What are the mix of various payment types? And what is the risk profile of your merchants? I do talk about payments are from Mars, software from Venus, but one of the key differences between these two domains is that on the payment side, we obsess about compliance and risk because it's a regulated business. And generally speaking, retail software is not regulated, and therefore the people who run these businesses have no conception of the kind of risk decisions or risk policies that the payment side's going to have. So clearly, if you're doing some kind of referral model where you're just passing leads backwards and forwards, it doesn't matter. But if you want to be trusted to onboard customers on behalf of your payment partner, you need to be onboarding customers that the payment partner is likely to accept, because it's in no one's interest that you spend all your marketing dollars recruiting customers and then find that they're getting rejected. So there's an element of training on both sides about compliance, and I think maybe some other key differences between the two sectors. I mean, one of them is around customer focus. There's no doubt that software companies are hyper customer focused. They live and breathe features and functions. The customers are on the phone all the time, asking for different things and roadmap changes and various integrations into other software and so on. Payment companies want to sell the same thing to everybody.
Yeah.
They're much more focused on their internal operations and economies of scale. And probably the third thing I'd highlight is that implication of that on allocation of capital. Software companies tend to spend more money on sales and marketing, and they spend more money on CapEx, whereas the payment businesses, economies of scale, spend more money on OpEx. And that's where, when you get into the kind of numbers that maybe Toast, you mentioned as probably one of the leaders here, if you're a software company making 80% of your money from payments, have you got the right incentive to keep your software up to date and make sure that you're focusing on what the customers really want from the software? Because that is that's the anchor on the customer relationship. So I think that's going to be a challenge for any business that begins to straddle these two domains.
Yeah, no, you're very right. I think, I really like the sentence from Mars and Venus, because it's really highlighting the fact a software company, has a very different business model. It has a very different aim, hasn't any relationship to payments. And, especially as you think about launching your own branded payments, that's already one step forward of, completely changing the direction of you from a strategic perspective, right? Then you have the second step, looking forward a couple of years and you becoming also a little bit more acquainted as it comes to how to run a business, a payments company in a sense, right? So if you actually become a PayFac, this means that you're in-housing so many different components that you need to build up a team. You need to, invest a lot. You're owning the risk, right? The sub-merchant risk. In addition to that, that's one of the core differences that we also observe, between the US and Europe. In Europe, you need to have a payment institution license, which you don't need in the US, meaning that from a regulatory perspective, you have some additional burden that you also need to comply with. That's also one of the reasons where what we see is you have way more SaaS platforms, number one, that are more scaled in the US because it's a large country. It's, it's less fragmented than Europe. But also from a regulatory perspective, it's easier to actually register as a PayFac. And in Europe, we are way far behind. And there's a proper difference as we compare that.
Well, indeed, the regulatory burden is considerable. So, any software company thinking of becoming a payment facilitator, this PayFac model, you need to get regulated. It's probably 10 to 15 staff you need to hire. You need to hire some consultants to write your proposals. So it's a high fixed cost. You wouldn't want to take that on unless you were certain you were going to have the volume to make it worthwhile. And probably the other difference between Europe and the US is in the US, there's a whole bunch of businesses offering PayFac as a service. So they take all the risk. You drag and drop your logo on it, you pay them some money, and off you go. That's only a very emerging sector in Europe. There are one or two, but it's nothing like as mature a category there. So we're coming up on time. So it's been a fascinating discussion, Charlotte. But in terms of what you're telling what you're hearing from your customers, you talk to a lot of big payment companies and big software companies as well. What are they going to be focusing on in this, I guess, for 2025?
Yeah, that's a really good question, Geoff. Listen, so I think for SaaS platforms, in Europe, in the UK, I think it's, focusing on, integrating payments and use cases beyond payments, right? So think about merchant cash advance, issuing, etc. So there's really an entire list of, use cases that you can actually integrate and embed into your product offering that are very, very lucrative. I think for payment service providers, that's really around, how can we work with software platforms? And then lastly, I think what the UK and Europe specifically needs to really work and figure out is just, the use cases on how to monetize C2B verticals are relatively obvious. It's less obvious in the B2B space yet. I think it's very much focused on the payout side. And it's what we need to ask ourselves is how can we make this pay-in and payout opportunity as interesting as, for example, what we observe in the US? So these would be my key takeaways.
I would agree. It's keeping it simple. It's being able to deliver as much of this wherever you are in the value chain. And I appreciate people watching this call are going to be at different positions in the value chain. Wherever you are in the value chain, offering whatever it is you do as a service to the next level down in the value chain. So eventually it gets in the hands of merchants in the most seamless way possible. And I think the folks that can do that are the ones that are going to win. And I think they can charge more money for it, right? I don't think this is commoditizing the industry. I think potentially it's offering a great many ways to add value. But unless people do, I think they're going to be severely challenged in 2025 and beyond. So Charlotte, great to talk. That was a fascinating discussion. I'm sure we're going to pick up more in Berlin. But thanks to everybody for listening to this MPE Talks episode. It's part of the MPE 2025 conference program. And that's going to be taking place March 18th to 20th. And we'll see you all in Berlin.